Good morning. With the notable increase in the size of the Fed's balance sheet over the past few years, many have asked, how can we safely reduce the size of the balance sheet? I propose a novel idea that reduces the size of one of the Fed's liabilities, a Federal Reserve note. And as you can see, we can actually reduce the size with a simple blow. And that just reduces the size of the Fed's liabilities by $19.
If only it were that easy, G. The agenda for today's meeting is to discuss current economic conditions and to recommend policies that will steer the economy in the right direction. Bill, please remind us of the Federal Reserve's dual mandate.
Thank you, John. The Fed's dual mandate is to maintain price stability and maximum employment. After the end of the recession in September of 2009, we saw the unemployment rate reach 10%, the highest it's been since 1983. Since then, we have seen consistent improvement in the unemployment rate. In September of 2013, we saw the unemployment rate reach 7.2%.
The U3 rate has been improving, but it's still above the target of 6.5%. And according to the Beveridge curve, there's been a fundamental shift in the labor market, resulting in skills mismatch and structural unemployment.
Let me interject. You can't ignore that the U6 rate, which includes marginally attached workers and workers employed part-time for economic reasons, is currently at 13.6%, compared to 8.4% in September of 2007, before the crisis. Prior to the recession, the differences between U3 and U6 hovered below 4 percentage points, while the spread now stands at 6.4%.
Great point, G. Additionally, the unemployment rate does not consider the average duration of unemployment, which currently at 36.9 weeks is substantially greater than the 16.6 weeks that we saw before the recession.
More importantly, we've seen propitious indications in regards to job separations over the past 4.5 years. In 2009, quits accounted for only 41% of total job separations, while through the first 8 months of 2013, quits accounted for 53% of job separations. This is a positive indicator, as there is now a lower proportion of workers being laid off, with the data trending more toward voluntary separation.
Okay, I think at this point we can shift gears and talk about the second part of the dual mandate, price stability. According to the BLS, the PCE is currently 1.2%. The CPI, a more volatile indicator of inflation, is also at 1.2%, and the core CPI is at 1.7%. All these numbers are comfortably below the target of 2%, despite the scale of quantitative easing and the recent increase in the size of the Federal Reserve's balance sheet.
Looking at economic growth based on the annualized change in real GDP from the previous quarter, in the 4 years prior to the recession, we saw an average growth rate of 2.6%. During the recession, we saw an average growth rate of negative 2.9%. In the 4 years since the recession, we've seen an average growth rate of 2.2%, which is slightly slower than we saw before the recession.
The BEA reports that in the 4 years prior to the recession, the annualized growth rate in corporate profits after taxes averaged 14%, before dropping to an average of 6% during the recession. Since then, profits have essentially been growing at pre-recessionary levels, averaging 13%. This recovery in profits is not translated into a cogent decrease in unemployment, though, a testament to the lag effect of corporate profits on hiring.
Part of the reason for the increase in corporate profits may be the labor productivity, which has risen every year, even during a recession, and grew at a rate of 1.2% in 2012 as compared to the year before.
Corporations might be doing well, but consumers are still concerned about the economy. The Consumer Sentiment Index produced by the University of Michigan dropped to 73.2 in October from 85.1 in July, in light of the recent government shutdown and its effects on consumers' economic expectations. This drop has corresponded with an increase in the personal savings rate, rising from 3.6% in January to 4.6% in August.
Well, gee, despite the apparent lack of confidence from consumers, we've seen no negative impact on housing prices, which are up 12.8% from a year ago, according to the Case-Shiller Index. This has been fueled by a drop in foreclosures and low mortgage rates.
Yeah, my concern is housing affordability, which according to multiple indicators is on decline, and that may threaten recovery in the housing sector.
While housing affordability may be down, it is still well above pre-recessionary levels, and therefore, in my mind, it is not a source of concern.
Okay, I think at this point we've sufficiently delved into the current economic environment. We've seen improvements in the unemployment rate, though it's still above the target of 6.5%, and we've seen positive indications regarding job separations. Next, although consumer sentiment appears to be trending downwards, we've seen improvements in housing prices, productivity, and corporate profits. Finally, GDP is growing, though at a slower rate than it was before the recession. Inflation remains below the 2% target. Does everyone agree with these general conclusions?
Yes.
Excellent. G, how about you begin our discussion on monetary policy by giving your thoughts on quantitative easing?
With the intention of keeping long-term interest rates low across the board, QE3 has contributed to the economic recovery. At the beginning of QE3, the 30-year conventional mortgage rate fell to 3.38%, a historic low, and the 10-year Treasury rate fell below 2%. Before June of 2013, when they both rose due to talks of tapering, QE3 has put our economy on the right track. But with slow GDP growth and still relatively high unemployment, it would be unwise to stop or slow asset purchases.
I vehemently disagree. QE worked for a period of time, but it is no longer effective. Essentially, QE is experiencing considerable diminishing returns. Or as President Fisher of the Dallas Fed puts it, QE is having a lesser impact as we go through time. Additionally, President George of the Kansas City Fed argues that QE is responsible for creating an unbalanced economy. While QE has lost its effectiveness, the economy is on a good recovery path, as was demonstrated in our outlook, as well as in the recent uptick in long-term interest rates. With this in mind, I propose that we terminate the large-scale asset purchase program immediately.
Good job. You just mentioned the recent uptick in interest rates as being a sign of economic recovery. But is it not possible that the only reason interest rates have risen is because of talks of tapering?
While it may be true that interest rates are rising due to the talks of tapering from the Fed, a much stronger reason for the increase in interest rates is due to improvements in the economy. We have seen an increase in corporate profits, which also raises their stock prices. Additionally, we've seen consistent improvement in the unemployment rate, as well as an increase in housing prices, which are positive signs for the economy.
But Bill, you just mentioned corporate profits. The problem is that although corporate profits are rising, firms are still hesitant to invest in newly earned funds. This is demonstrated by the enormous quantity of corporate deposits. In fact, according to Paul Krugman, although firms are now earning a larger share of total income, they're hesitant to redistribute or invest these funds due to concerns relating to global economic uncertainty.
Quantitative easing has done all that it can to improve economic conditions. According to Martin Feldstein of Harvard, the bond buying program may have had a stimulatory effect in 2010 and 2011, but this effect is no longer present. In addition, QE has raised the size of the Fed's balance sheet to unprecedented levels, sparking inflationary concerns, something that could end up hurting the economy in the long run.
John, this really is not a major concern. The Fed can safely reduce the size of the Fed's balance sheet through natural maturing of securities through time and the possible sale of securities through open market operations.
But gee, the large balance sheet will almost certainly have inflationary effects in the future. The economists Martin Feldstein of Harvard and Alan Meltzer of Carnegie Mellon share similar concerns that the large quantity of reserves will become inflationary when the economy fully recovers, because these reserves will be converted into new loans, causing faster money growth.
Speaking of Feldstein, he also writes about how investment activities are destroyed by quantitative easing. This is another reason to end QE. Long-term interest rates are being kept very low by quantitative easing, which implies unsustainable prices of bonds and other securities. When interest rates rise, as they inevitably will, the holders of those securities will incur considerable losses, which may lead to bankruptcies and collapses in the financial markets. The Fed should stop supporting bond markets.
Okay, Bill and John, I understand your points of view. However, I do not think that the current economic environment justifies the full removal of quantitative easing. I am, however, amenable to the idea of a gradual reduction of quantitative easing, both because this will keep inflation expectations stable and allow for continued economic stimulus. Additionally, it would prevent interest rates from rising too rapidly, which, Bill, as you mentioned, would harm bondholders.
I agree. Perhaps a gradual reduction in purchases is warranted.
Well, Jacob and G, I guess you aren't entirely incorrect. The impact of inflation expectations is certainly worth considering. How about we begin tapering at a rapid rate of $28 billion per month? Taking this approach would fully end QE within 3 months. With QE1 and QE2 as precedents, we've seen no negative ramifications on the economy associated with ending QE abruptly.
The ramifications of ending QE1 and 2 abruptly were that they had to be followed by further rounds of quantitative easing. We absolutely need to taper. However, a soft taper seems to go hand in hand with median market expectations of $20 billion monthly, according to a survey of the Fed's primary dealers. In addition, a pullback in purchases must be done without having too radical an effect on long-term interest rates. Separately, we must not raise the federal funds rate for an extensive period of time.
Based on the Fed's projections, in June of 2014, the unemployment rate should hit 6.5%. As such, I suggest that we begin to taper in January of 2014 at a rate of $15 billion a month to end quantitative easing by this time. However, if Congress is unable to come to compromise in order to raise the debt ceiling and approve a budget in February, we may need to slow down and pause tapering.
$15 billion per month sounds reasonable, and I agree it's important to keep an eye on Congress. However, what aspect of quantitative easing should we taper faster?
As Boston Fed President Eric Rosengren would support, the purchase of mortgage-backed securities has positively impacted the housing sector. And the reason, and the purchase of U.S. Treasuries should therefore be tapered at a faster rate than the purchase of mortgage-backed securities.
I'm a little hesitant on the purchase of mortgage-backed securities. The Fed's never held this volume of MBSs in the past, and as such, we don't know how they will affect the Fed's balance sheet in the future.
No, while you raise a good point, I agree with G and think that the purchase of mortgage-backed securities is serving the critical role of supporting the housing sector.
It'd be reasonable to begin tapering both U.S. Treasuries and mortgage-backed securities, but to taper U.S. Treasuries at a faster rate. For instance, in the first month of tapering, the entire $15 billion reduction would comprise of U.S. Treasuries. In the second month, the Fed can scale back its purchases of U.S. Treasuries by $10 billion and its purchases of mortgage-backed securities by $5 billion, and so on and so forth.
I agree. This would be a conservative approach that would slow down purchases without having too radical an effect on long-term interest rates. In order to offset this policy of tapering, the Fed could entirely cut the interest it pays on excess reserves. Over the past 9 months, excess reserves have risen by over $755 billion to over $2.2 trillion today. This policy would encourage banks to lend as it increases the opportunity cost of not doing so.
In 2012, the ECB slashed the interest rate on excess reserves from 25 basis points down to 0 basis points. This did not have the desired effect on the growth rate of monetary aggregates. Prior to the policy, the compound monthly growth rate of the M1 money stock was 59 basis points. After the policy change, the growth rate actually dropped to 52 basis points. Other factors may have been in play, but this suggests that such a policy would not cause lending to noticeably rise. Furthermore, slowing down and eventually ending QE will naturally reduce the amount of excess reserves in the system, as we have seen in the past.
So given that slashing interest rate and excess reserves would not dramatically increase lending, I think it's important to keep that interest rate because it serves as a floor for the federal funds rate.
Actually, the federal funds rate of 8 basis points is below the interest paid on excess reserves.
Okay, Bill, let me clarify. The interest rate on excess reserves is not a perfect floor for the federal funds rate, and that's because some financial institutions cannot receive interest on their excess reserves. But it is the closest thing to a floor we have at the present moment.
What about the experimental overnight fixed-rate reverse repurchase agreements, which began testing in September of 2013? This allows all financial institutions that participate in the federal funds market to make loans to the Federal Reserve overnight, with the Fed putting up Treasury securities as collateral. The Fed pays interest on the loan and repays the amount the next day. If this program is found to be successful following extensive testing, this could certainly serve as a more effective floor for the federal funds rate.
Would it be fair to say that we all support the use of the reverse repos program, but feel that it is necessary to monitor how markets react, and that we want to keep the interest rate on excess reserves in place as a safety precaution?
Yeah. So to bring this all together, we recommend that the third round of quantitative easing begin being tapered in January of 2014. It should be tapered at a rate of $15 billion per month, with the purchase of U.S. Treasuries being tapered at a faster rate than the purchase of mortgage-backed securities. Next, we recommend that the target for the federal funds rate remain where it is for an extended period of time due to the fact that we're only seeing moderate economic growth. Finally, the interest rate and excess reserves should remain while we continue to assess the effectiveness of the overnight repurchase agreements. To bring this full circle, it looks like we don't have to rely on magic to solve the problems that are currently facing the economy.
Thank you.
Thank you.
All right, I will get the ball rolling. First quick question I have for you is, I just want you to give me a sense of the risks and benefits, I suppose, but I think of the benefits pretty clearly. The risks of persistently low nominal interest rates.
Okay, so one of the risks that are associated with the persistently low nominal interest rate just deals with the tools of the Federal Reserve. So there's something called liquidity trap, and that's basically when the Federal Reserve can't really use the federal funds rate as an effective tool to regulate the economy.
Yeah, as Jacob mentioned, with the liquidity trap, traditional monetary policy tools like open market operations may not be as effective because those are used to manipulate this federal funds rate. But when it's already so close to zero, it may not, be useful to proceed with open market operations, which requires the Fed to be a little bit innovative and use newer monetary policy tools such as the interest rate on excess reserves and this new reverse repos program that G talked about in our presentation.
In fact, Keystone and McAndrews of the New York Fed argue that with the interest that they now pay on excess reserves, this allows the Fed to adjust the target for the federal funds rate without directly changing, without having an effect on the level of reserves in the system. So it's actually a new innovative way. Because right now there's such a high level of reserves. And even when we see the economy recover, yes, that number will dwindle, but it'll still be a very high number. And therefore, that's why traditional open market operations would have to be conducted on such a large scale to have an effect on the federal funds rate. That now that it has these policy tools, it actually has a more effective control of it.
Another possible negative for inflation would be, according to the Fisher effect, with normal interest rates so low, the real interest rate could end up being negative due to increases in inflation.
And what are the problems with that?
Well, then basically, if you have a security, in the future, it's going to be worth less money than when you initially bought it. So you have a loss on something that's supposed to be safe.
And just one final thing in terms of the monetary policy tools. The prominent monetary economist, Michael Woodford of Columbia, he recently wrote a paper in 2012 on these, low zero bound interest rates, saying that it is going to cause the Fed to have to pursue different monetary policy tools. He advocates using forward guidance as a more strong tool, and different balance sheet policies to change the composition or even the size of the balance sheet.
Good. Okay. So earlier you put the beverage curve up and illustrated, to help illustrate your discussion of the labor market. Could you comment just a bit about what this shift in the beverage curve does or doesn't tell us?
So to start us off for the beverage curve basically plots job vacancies with the unemployment rate. And what we see according to the data is a very noticeable shift in the data points, which would indicate, as we said in the presentation, higher structural unemployment.
So basically, with the beverage curve over here, we see that there's now higher structural unemployment. And that's partially caused by the fact that many Americans are underwater on their mortgages. And therefore they can't sell their house and move to a place where there are job openings. And actually, we've seen negative equity rates go down. There are currently 12.2 million mortgages are underwater. That number is down from 15 million in July of 2012. And it creates a so-called wealth effect.
So just to kind of follow up on the structural issue, so to the extent that we've seen this then get embedded in structural unemployment, does that affect your estimate of what maybe the actual rate of unemployment is for the economy?
Yeah, well, traditionally it hovers around 5% or so, but the latest estimates that we've looked at is closer to 6% now. That's according to the FRED database via the Congressional Budget Office.
So why is it coming down?
Why does it start going up?
Why is it
So just one possible factor to look at there is we have noticed demographic shifts, and over time, the effects of the demographic shift should also begin to decline. But we also expect the natural rate of unemployment to start to become more attractive as we progress and the economy continues to improve with some of these structural factors. For instance, the homes in foreclosure would also become less of an issue as
so that beverage curve shifts back?
I'm going to ask you about your Esther George reference. And could you say a little more about why she thinks QE, because she's been the dissenter for a very long time. What does she mean by an unbalanced economy?
It goes back to ties into the Martin Feldstein point that we talked about the impact of stock market expectations and how they're distorting stock market activity, distorting investment activity. I think Jacob can comment on that.
Yes, so really kind of the idea of like an unbalanced economy is sort of the idea that the economy is being supported by artificial factors, and when those artificial forces are removed, the economy is more predisposed to be unstable you might have negative ramifications when you lose those support structures. So that's
Where are the artificial factors coming from?
so, and that deals with distorting investment activities. So
The factors are from the fact that the Federal Reserve is buying $85 billion of bonds every single month. Normally, those bonds.
I did get you to say it.
They're not bought at that kind of rate, but because the Federal Reserve has been going through all these large-scale asset purchases with their third round of quantitative easing now, and that's been buying a lot of the U.S. debt, and it's been lowering the interest rates on U.S. Treasuries, which also lowers other interest rates as well, because the U.S. bonds are seen as having no risk, so it's used in order to calculate the risk premium.
And that sort of relates to our idea of tapering, because by slowly getting rid of these supports, we're able to let the markets adjust, and at the end, hopefully, it's no longer an unbalanced situation.
So that going forward, eventually the market itself becomes the major determinant of prices.
Now, in formulating your perspective on the economy, presumably you have some notion of what the potential growth rate for the economy is. I know you didn't speak directly to it, but you talked about obviously the labor and the long-term prospects for the economy's recovery. But if you think about sort of long-term potential GDP growth, and you wanted to come up with a quick estimate, how would you do that? What pieces go into computing potential GDP growth?
Well, one thing that would be having an impact on future potential GDP growth would be labor productivity. As we mentioned in our presentation, labor productivity has been going up year over year.
And
An additional thing with labor productivity is certain segments of the population are now becoming more educated due to certain factors relating to the unemployment situation. So when those people do graduate with their higher degrees of education, we would also see an increase in labor productivity.
There's also the more traditional rule of thumb, Oakland's law, a decrease of 1% unemployment associated with 2% increase in GDP growth.
Right.
furthermore, there's also consumer sentiment. Since the U.S. is a consumption-driven economy, we can actually use consumer sentiment as one of the factors we can use to predict future GDP growth. And lastly, business confidence, which according to the Moody's Analytics survey last week, business confidence is actually on the uptick.
Okay, so I think I gathered your policy statement and your recommendation. I think I got it pretty good. And you actually recommend, I think, the composition of your tapering slide. I don't know what slide number that is, but that's the title of it. There it is. Okay, so it's really important for the Fed, of course, to be transparent in its policymaking. So how are you going to communicate this strategy to the public? Or is that important?
So to start off, it's definitely very important to have a strong communication strategy to the public and to remain transparent, because that does affect people's confidence in the central bank and it works strongly on expectations.
In addition, tapering actually boosts confidence in the Fed's forward guidance measures. Actually, back in September, when Ben Bernanke announced that the Federal Reserve was not going to begin tapering, that actually disappointed the market because that actually disappointed the market as everybody expected them to taper. But actually, if you actually taper and you say you're going to do something and you actually follow through with it, that it can actually strengthen the Fed's credibility. And for monetary policy to be conducted effectively, there has to be a certain level of predictability that comes with it. And being transparent and being very clear about what we're going to do is essential if we want our policy recommendation to be effective.
And then you could make a table like that.
Thank you.
Thank you.
Thank you.
Welcome, Team 3. We are on our third leg of the finals here. And like this morning, you will have 15 minutes for your presentation, 10 minutes Q&A, and as your timekeeper, I have the 5-minute, 2-minute, and please finish card, and that's going to be, if you hit please finish, you can finish your sentence, and that's it. I'd like to ask our judges to introduce themselves to you.
Hi, I'm Mary Burke, Senior Economist in the Research Department.
I'm Daniel Cooper, Senior Economist in the Research Department.
Yolanda Kajitsky, Vice President in the Research Department and Director of our New England Public Policy Center.
Now, if I could ask you to introduce yourselves again, totally anonymous, so your names are safe. No place, no school, so start with William.
Hello, my name is Bill.
Bill.
My name is Jacob.
I'm John.
I'm G.
And what is that, sorry? Brianna, okay. So I'm your timekeeper, I will go over there, and when you tell me you are ready, then high sign, and I will start the clock.
Can you copy of our slides for our presentation?
Thank you.
Good afternoon. With the notable increase in the size of the Fed's balance sheet over the past few years, many have asked, how can we safely reduce the size of the Fed's liabilities? I propose a novel idea that reduces the size of one of the Fed's liabilities, a Federal Reserve note. And as you can see, we can actually reduce the size of this liability with a simple blow. I just reduced the size of the Fed's liabilities by $19.
If only it were that easy, G. The agenda for today's meeting is to discuss current economic conditions and to recommend policies that will steer the economy in the right direction. Phil, please remind us of the Federal Reserve's dual mandate.
Thank you, John. The Fed's dual mandate is to maintain price stability and maximum employment. After the end of the recession in September of 2009, we saw the unemployment rate reach 10%, the highest it's been since 1983. Since then, we have seen consistent improvement in the unemployment rate. In September of 2013, the unemployment rate was at 7.2%.
The youth rate has been improving, but it's still above the target of 6.5%. And according to the beverage curve, there's been a fundamental shift in the labor market, causing skills mismatch and structural unemployment.
Let me interject. You can't ignore that the U6 rate, which includes marginally attached workers and workers employed part-time for economic reasons, is currently at 13.6%, compared to 8.4% in September of 2007, before the crisis. Prior to the recession, the differences between U3 and U6 hovered below 4 percentage points, while the spread now stands at 6.4%.
Great point, Chief. Additionally, the unemployment rate does not consider the average duration of unemployment, which currently at 36.9 weeks is substantially greater than the 16.6 weeks that we saw before the recession.
More importantly, we have seen propitious indications in regards to job separations over the past 4.5 years. In 2009, quits accounted for only 41% of total job separations, while through the first 8 months of 2013, quits accounted for 53% of job separations. This is a positive indicator as there is now a lower proportion of workers being laid off, with the data trending more toward voluntary separation.
Okay, I think at this point we can shift gears and talk about the second part of the dual mandate, price stability. According to the BLS, the PCE is currently 1.2%. The CPI, a more volatile indicator of inflation, is also at 1.2%. And the core CPI is at 1.7%. All these numbers are comfortably below the target for 2%, despite the scale of quantitative easing and the recent increase in the size of the Federal Reserve's balance sheet.
Looking at economic growth based on the annualized change in real GDP from the previous quarter, in the 4 years prior to the recession, we saw an average growth rate of 2.6%. During the recession, we saw a negative growth rate of 2.9%. In the 4 years since the recession, we've seen an average growth rate of 2.2%, which is slightly slower than we saw before the recession.
The BEA reports that in the 4 years prior to the recession, the annualized growth rate in corporate profits after taxes averaged 14%, before dropping to an average of 6% during the recession. Since then, profits have essentially been growing at pre-recessionary levels, averaging 13%. This recovery in profits has not translated into a cogent decrease in unemployment, though, a testament to the lag effect of corporate profits on hiring.
Part of the reason for the increase in corporate profits may be due to labor productivity. Labor productivity grew by 1.2% in 2012 as compared to the year before. This is a positive sign for the economy, as productivity drives economic growth in the long run.
Corporations might be doing well, but consumers are still concerned about the economy. The Consumer Sentiment Index produced by the University of Michigan dropped to 73.2 in October from 85.1 in July, in light of the recent government shutdown and its effects on consumers' economic expectations. This drop has corresponded with an increase in the personal savings rate, rising from 3.6% in January to 4.6% in August.
Well, gee, despite the apparent lack of confidence from consumers, we've seen no negative impact on housing prices, which are up 12.8% from a year ago, according to the Case-Shiller Index. This has been fueled by a drop in foreclosures and low mortgage rates.
John, my concern is housing affordability, which according to multiple indicators is on the decline, and that may threaten the recovery of the housing sector.
But while housing affordability may be down, it is still well above pre-recessionary levels. Therefore, in my mind, it is not a source of concern.
Okay, I think at this point we've sufficiently delved into the current economic environment. We've seen improvements in the unemployment rate, though it's still above the target of 6.5%, and we've seen positive indications regarding job separations. Next, although consumer sentiment appears to be trending downwards, we've seen improvements in housing prices, productivity, and corporate profits. Finally, GDP is growing, though at a slower rate than it was before the recession, and inflation remains below the 2% target. Does everyone agree with these general conclusions?
Yes.
Excellent. Gee, how about you begin our discussion on monetary policy by giving your thoughts on quantitative easing?
With the intention of keeping long-term interest rates low across the board, QE3 has contributed to the economic recovery. At the beginning of QE3, the 30-year conventional mortgage rate fell to 3.38%, a historic low, and the 10-year Treasury rate fell below 2%, until June of 2013, when they both rose due to talks of tapering. QE3 has put our economy on the right track, but with slow GDP growth and still relatively high unemployment, it would be unwise to stop or slow asset purchases.
I vehemently disagree. QE worked for a period of time, but it is no longer effective. Essentially, QE is experiencing considerable diminishing returns. Or as President Fisher of the Dallas Fed puts it, QE is having a lesser impact as we go through time. Additionally, President George of the Kansas City Fed argues that QE is responsible for creating an unbalanced economy. While QE has lost its effectiveness, the economy is on a good recovery path, as was demonstrated in our outlook, as well as in the recent uptick in long-term interest rates. With this in mind, I propose that we terminate the large-scale asset purchase program immediately.
John, you just mentioned the recent uptick in interest rates as being a sign of economic recovery. However, is it not possible that the only reason interest rates have risen is because of talks of tapering?
Well, it may be true that interest rates are rising due to talks of tapering, but a much stronger reason for the increase in interest rates is due to improvements in the economy. We have seen an increase in corporate profits, which also raises their stock prices. Additionally, we have seen improvement in the unemployment rate, as well as an increase in housing prices, all of which are positive indicators for the economy.
Bill, you just mentioned corporate profits. The problem is that although profits are rising, firms are still hesitant to invest in newly earned capital. And this is demonstrated by the enormous quantity of corporate deposits. In fact, according to Paul Krugman, although firms are now earning a larger share of total income, they're hesitating to invest or redistribute these funds due to concerns relating to global economic uncertainty.
Quantitative easing has done all that it can to improve economic conditions. According to Martin Feldstein of Harvard, the bond buying program may have had a stimulatory effect in 2010 to 2011, but this effect is no longer present. Additionally, QE has raised the size of the Fed's balance sheet to unprecedented levels, sparking inflationary concerns, something that could end up hurting the economy in the long run.
John, this really is not a major concern. The Fed can safely reduce the size of the Fed's balance sheet through natural maturing of securities through time and the possible sale of securities through open market operations.
Well, gee, the large balance sheet will almost certainly have an inflationary effect in the future. Economists Martin Feldstein of Harvard and Alan Meltzer of Carnegie Mellon share similar concerns, that the large quantity of reserves will become inflationary when the economy fully recovers, because these reserves will be converted into new loans, causing faster money growth.
Speaking of Feldstein, he also writes about how investment activities are distorted by quantitative easing. This is another reason that we should end QE. Long-term interest rates are being held very low by QE, implying unsustainable prices of bonds and other securities. When interest rates rise, as they inevitably will, the holders of these securities will incur considerable losses and may lead to bankruptcies and collapses in financial markets. The Fed should stop artificially supporting bond markets.
Okay, Bill and John, I understand your points of view. However, I do not think that the current economic environment justifies the full removal of quantitative easing. I am, however, amenable to the idea of a gradual reduction of quantitative easing, both because this will keep inflation expectations stable and allow for further economic stimulus. Additionally, it would prevent interest rates from rising too rapidly, which, Bill, as you mentioned, would harm bondholders.
I agree. Perhaps a gradual reduction in purchases is warranted.
Well, Jacob and G, I guess you aren't entirely incorrect. The impact of inflation expectations is certainly worth considering. How about we begin rapidly tapering at a rate of $28 billion per month? Taking this approach would fully end QE within 3 months, With QE1 and QE2 as precedents, we've seen no negative ramifications on the economy associated with ending QE abruptly.
The ramifications of ending QE1 and 2 abruptly were that they had to be followed by further rounds of quantitative easing. We absolutely need to taper. However, a soft taper seems to go hand in hand with median market expectations of $20 billion monthly, according to a survey of the Fed's 21 primary dealers. In addition, scaling back purchases must be done without having too radical effect on long-term interest rates. Separately, we must not raise the target for the federal funds rate for an extensive period of time.
Based on the Fed's projections, the unemployment rate should reach 6.5% by June of 2014. As such, I suggest that we begin tapering in January of 2014 at a rate of $15 billion a month in order to end QE by this time. However, if Congress is unable to compromise and wants to raise the debt ceiling and approve a budget in February, we may need to slow down and pause tapering.
$15 billion per month sounds reasonable. I agree we need to keep an eye on Congress. However, what aspect of quantitative easing should we taper faster?
As Boston Fed President Eric Rosengren would support, the purchase of mortgage-backed securities has positively impacted the housing sector, and therefore the purchase of U.S. Treasuries should be tapered first, before slowing down the purchase of mortgage-backed securities.
I'm a little hesitant on the purchase of mortgage-backed securities. The Fed's never held this long of the assets in the past, and as such, we don't know how these assets will affect their balance sheet in the future.
Oh, while you raise a good point, I agree with G that the purchase of mortgage-backed securities is serving a critical role supporting the housing sector.
It'd be reasonable to begin tapering both U.S. Treasuries and mortgage-backed securities, but to taper U.S. Treasuries at a faster rate. For instance, in the first month of tapering, the entire $15 billion reduction would comprise of U.S. Treasuries. In the second month, the Fed could scale back its purchases of U.S. Treasuries by $10 billion and its purchases of mortgage-backed securities by $5 billion, and so on and so forth.
I concur. This would be a conservative approach that would not have too radical effect on long-term interest rates. In order to offset this policy of tapering, the Fed could additionally entirely cut the interest rate that it pays on excess reserves. Over the past 9 months, excess reserves have risen by about $755 billion to over $2.2 trillion today. This policy would encourage lending, as it increases the opportunity cost of not doing so.
But gee, in 2012, the ECB slashed the interest rate on its excess reserves from 25 basis points down to 0 basis points. This did not have the desired effect on the growth of monetary aggregates. Prior to the policy, the compound monthly growth rate of the M1 money stock was 59 basis points. After the policy change, the growth rate actually dropped to 52 basis points. Other factors may have been in play, but this example suggests that lending would not noticeably rise following such a policy. Additionally, slowing down and eventually ending QE will naturally reduce the amount of excess reserves in the system, as we have seen in the past.
So given that slashing the interest rate on excess reserves would not dramatically increase lending, I think it's important to keep that interest rate because it serves as a floor for the federal funds rate.
Actually, the federal funds rate at 8 basis points is actually below the interest rate on excess reserves.
Let me clarify, Bill. The interest rate on excess reserves is not a perfect floor for the federal funds rate. That's because some financial institutions are not allowed to receive interest on their excess reserves.
What about the experimental overnight fixed rate reverse repurchase agreements, which began in September of 2013? This allows all financial institutions that participate in the federal funds market to make loans to the Federal Reserve overnight, with the Fed putting up Treasury securities as collateral. The Fed pays interest on the amount and repays the loan the next day. If this program is found to be successful following extensive testing, this could certainly serve as a more effective floor for the federal funds rate.
It would be fair to say that we all support the use of the reverse repos program, but feel that it is necessary to monitor how markets react and want to keep the interest rate on excess reserves in place as a safety precaution.
Yeah. So to bring this all together, we recommend that the third round of quantitative easing begin being tapered in January of 2014. It should be tapered at a rate of $15 billion per month, with the purchase of U.S. Treasuries being tapered at a faster rate than the purchase of mortgage-backed securities. Next, we recommend that the target for the federal funds rate remain where it is for an extensive period of time due to the fact that we're only seeing moderate economic growth. Finally, the interest rate on excess reserves should remain while we continue to assess the effectiveness of the overnight repurchase agreements. To bring this full circle, it looks like we don't need to rely on magic to solve the problems that are currently facing the economy.
Thank you.
Thank you very much. All right, let me reset this. When you are ready.
Can you talk about whether you think there's been sustained or improvement in the labor market since September 2012, please?
So to start off, we definitely have seen improvements in the labor market since September. In terms of the magnitude of whether it be sustainable, we would say that we have begun to see indications that these improvements are becoming would be classified as sustainable. However, we'd like to see more significant improvements before we deem them to be fully sustainable.
The civilian unemployment rate has obviously been increasing as we've been pretty much every month as we've seen as of late. But the key indicator that we still see as a threat would be the U6 rate, which of course includes the marginally attached workers and those employed part-time for economic reasons. The difference between that and the U6 rate, which would actually just isolate the marginally attached workers and those employed part-time, typically prior to the recession hovered below 4%, but it's still above 6%. So a fully recovered labor market would ideally have that figure back toward pre-recessionary levels of 4%.
Furthermore, there's a lot of potential for further improvements in the labor market. We've seen corporate profits rising, and actually, according to the Moody's survey of business confidence is actually on the uptick, which is a positive indicator, especially with regards to investment and hiring. Right now, we've seen a lag effect between corporate profits and hiring because there's still economic uncertainty, and that's actually the reason why corporations are not hiring where they should be yet.
Yeah, we saw that corporate profits are essentially back to pre-recession levels, but the unemployment is not. So there is a lag effect. So they kind of have the cash sitting there, but the effect of unemployment has not really manifested itself yet.
Additionally, we've also seen improvements in labor productivity, which means as the unemployment rate continues to drop, you will see a greater increase in GDP growth.
And then to tie that back into our recommendation, the process of tapering will allow us to continue to stimulate the economy through continued quantitative easing, though at a lesser and lesser magnitude. And we also recommend to keep short-term interest rates low for an extended period of time, which will also help in the improvements of the unemployment rate.
You've provided a very clear recommendation on tapering. I'm wondering whether you've considered adding some conditions to your recommendation. For example, do you think would you change your recommendation depending upon what happens with fiscal policy?
So to start us off, we did consider those other factors when we were creating this plan. In terms of our recommendation to taper at $15 billion per month, that was based in terms of the potential for a future partial government shutdown. We assumed that would not occur because our analysis of the probability of that occurring, being that it was unlikely. However, we have created contingency plans in case that is the event that does occur.
I can begin by summarizing basically to give us a historical perspective of what happened quickly in the past government shutdown. The Council of Economic Advisors projects that fourth quarter GDP growth will fall off by 0.25 annualized percentage points. They also cite that 120,000 private sector jobs were lost. The S&P has a bit more radical estimation. They predict that fourth quarter GDP growth will drop from 3% to 2.4%, annualized, of course. And the S&P also estimates that it costs the economy $24 billion.
With regards to another government shutdown, and it's certainly a possibility, but the Senate Minority Leader, Mitch McConnell, has indicated that there will not be another government shutdown. In addition, several party leaders from both sides of the aisle have indicated their willingness to come together and reach a deal before the December 13th deadline. Nevertheless, a shutdown is still possible, and the Fed must be able to respond appropriately to any scenario.
Looking at the main concern of a government shutdown would be the possibility if the government starting to default on its debt, which would have huge ramifications to the economy. As right now, the U.S. bonds are seen as being risk-free, but if the government starts to default on that debt, that would show that's kind of not true. If that does happen, it would have some huge impacts, but it might also affect unemployment. And based on that, we created an equation in order to how would we adjust the rate at which we're tapering. We won't plan on actually increasing it, but we will plan on reducing the amount of tapering.
So this is actually an equation that details exactly what would happen. So we're tying tapering to unemployment. And in the event that a government shutdown does occur, obviously that would have an effect on unemployment. And actually, we predict unemployment to go down by 0.1% each month as we taper. And in the event that a government shutdown actually reverses that and we see unemployment go up, then we can actually, we would stop tapering. And in the event that we don't see unemployment, when we see unemployment going down at a slower pace, we can actually adjust our formula of tapering. So that over here, that number over here is actually what the taper amount would be in a given month. And then over here, it's actually a very simple equation in which you subtract the taper amount from all the previous months minus the initial amount, and then put it over your current unemployment minus your unemployment target, which is 6.5%, over the expected change in unemployment. So this would essentially be a contingency plan in the event that a government shutdown does have an effect on unemployment.
One key thing that I would like to add, this equation, though it may, if unemployment were to increase drastically, it may indicate tapering at a faster level. But we've decided that we will not taper more than we already are, because the implications of the Fed's credibility and the forward guidance policies, that would kind of cause that out of whack, and markets may react in a negative way. So this will be a discretionary tool to help in the taper, but will not, we don't want tapering to be going all over the place. We want to be sending a clear message to the public.
Right, and then so to kind of tie it back into our policy recommendation, the 15 billion per month taper was based upon what we thought would be the most likely scenario, and that would be what we would stick to in an ideal environment. However, if we saw the unemployment rate start to rise or a partial government shutdown became a concern, we would rely on that equation in part to determine what to do in the future.
You mentioned that President George of the Kansas City Fed said that the expansion of the balance sheet had led to an unbalanced economy. I was wondering if you could elaborate on what you think she meant by that and how valid that statement is.
Okay. So to kind of start that off, in terms of what an unbalanced economy would be, it is essentially an economy that's supported by artificial structures, so that if those artificial structures were to be immediately removed, that economy would be predisposed to instability and you would run into potential issues. In terms of how currently we're having an unbalanced economy, the large effects of QE would be distorting stock investments and bond purchases, and therefore would add artificial support.
Yeah, as Bill mentioned in the presentation, QE has actually been inflating bond prices, and actually that obviously puts downward pressure on interest rates. And interest rates will eventually rise once we continue to see economic recovery, and that would hurt bondholders. Furthermore, we've seen QE actually fuel a stock market rally due to the portfolio rebalancing effect. It's spurred typically risk-averse investors to actually invest in the stock market, and we could actually see the stock market actually go back down. That would hurt the economy.
She brought up the impact, and Bill mentioned it earlier, about the increase in bond prices as a result of QE. The prominent monetary economist, Michael Woodford of Columbia, actually argues something very similar at this point, saying that the central bank is actually harming regular savers with the QE program and not doing much to boost the broader economy, because they're really the ones who are buying these treasuries for long-term retirement purposes.
And then to tie again back to our policy, essentially by tapering at a rate of 15 billion per month, we are giving markets the opportunity to adjust. And therefore, once we stop tapering, the markets will hopefully be back in a scenario where we don't have an unbalanced economy.
Can you just briefly touch on what you think the evidence is of skills mismatch and structural unemployment? Like, give an example of one thing that might be leading to that or something.
Yeah, we've seen an increase in the length of duration of unemployment, which could mean that people who might have some really useful skills at one point, after their longer duration of unemployment, they may have, those skills may deteriorate a little bit, which might mean that they're no longer able to do as good a quality work as they were able to before they long stint of unemployment.
Just one quick thing, excuse me for the pronunciation. Rand Gaya, who actually works here at the Boston Fed, he cites that the extended unemployment benefits are actually partly a reason behind the shift. Seeing that people the incentive, disincentives to get back into the labor market because they're receiving such great unemployment benefits. And this, you know, it's the same unemployment rate but more job vacancies because they're not going